On today's hot sheet, I'm discussing the Case-Shiller home price indices, which were just released this morning, plus why Wells Fargo and Goldman Sachs agree we've entered a housing recession again, I'll add, and the 10 fastest housing markets in the U.S. Today is Tuesday, October 31st, 2023. I am Byron Lazine, and the hot sheet starts now. Okay, good morning here on this Tuesday hot sheet edition, Halloween edition here on the hot sheet. Let me know which market you are tuning in from in the live chat. Let me know if you're dressing up or not today. If you're dressing up, let us know what you're going to be dressing up as later today on this Halloween. To get the most out of our content here at BAM, join BAMX, use code HOT to get 10% down below. You get access to all of our daily downloads. We've got a whole bunch to share here on this hot sheet as well. So S&P CoreLogic Case-Shiller indices were released today. Case-Shiller is viewed as the gold standard on home pricing, and home prices have gone nowhere but up as of late, as validated by Case-Shiller. Now, most of this information we've seen from other reports that home prices have been up, but Case-Shiller is usually lagging and is the most accurate data, or considered the most accurate data by many. The S&P CoreLogic Case-Shiller Index, a leading measure of U.S. home prices, reported data for August 2023, indicating that 13 of the 20 major metro markets experienced month-over-month home price increases. Now, August would make sense for major, home price improvements or upgrades or gains, right? Because we're coming out of that spring buyer season, right? If you bought a house in June, it likely closed in August. Okay. August is that month where you want to close out. A lot of buyers are closing out before traditional school season will start across the country. So August having a high increase in home values makes sense to me. The annual change, so year over year in August, was up 2.6%. Last August, there was a belief out there that home prices had peaked, but we're up 2.6% from that point right now. It's up 1.1% from the previous month. So August was up a full percentage point from July. The 10-city composite saw an increase of 3% year over year. I'll give you in a second here. I'll show you the chart for the 20-city composite as well as the 10-city composite. It'll be available for BAMX members in the daily download, and which cities are in the 20-city and the 10-city. The 10-city composite saw an increase of 3% year over year, while the 20-city composite posted year over year increases of 2.2%. Okay, so nationally, year over year in August, Case-Shiller says 2.6% up on home prices. 10-city, 3%, 20-city, 2.2%. So all the major measurements for Case-Shiller up year over year as of August. Really important. Chicago had the highest year over year gain among the 20 cities in August, leading the list for the fourth consecutive month. So Chicago, the hottest of the major 20 cities tracked by CoreLogic. Chicago, New York, and Detroit were the top performing metropolitan areas in August. Las Vegas and Phoenix were at the bottom of the rankings, okay? The Northeast and the Midwest regions did the best. Those are also the best, meaning and strongest in terms of prices. Those are also the weakest for inventory, okay? So it makes sense the areas that have the least amount of inventory are shooting up on price the most. That's the Northeast and the Midwest. All right, let's take a look at some of these charts here. Let's just take a look nationally over the last year, up 2.6% again here on CoreLogic's return. They call it a 2.57 return, 2.6% increase on home values for the national price index. Okay, so yeah, if we go out 3 years here, you can see what that looks like. Quite a gain from 3 years ago. And if we go into the 5-year gain, There you go. Let's go back here to the 1 year. This on the left here, that was like formerly the peak, right? The peak prices in 2022. We've now dipped down seasonally. If you listen to yesterday's hot sheet, and you can go listen to the hot sheet on Apple or on Spotify if you ever want to re-listen and you don't want to go to YouTube. If you typically listen to pods there, we're on both Apple and Spotify. I'd love to get a review from hot sheet listeners there. But we talked about this seasonal dip. We talked about this year might come later as we accumulate more inventory, hopefully over the next couple of weeks. But as people take their homes off the market, as less buyers are searching, yes, there will be even less buyers than there was the last 3 months going forward over the next 3 months. Hard to believe, but it's the seasonal truth. You can see here that the lowest prices typically in every market will happen from now until about February, where they bottom out and start to go up. That's what happened this year in terms of prices. Prices started to go down in the winter and then are now going back up. And this is probably right around this August number is probably right around that peak number. Okay, so there's the national look. Here is the 20 city composite home price index from Case-Shiller showing a similar story. Okay, above last year's peak in 2022, year over year, we are at a 2.2% return. The 20 city composite for the home price NSA index seeks to measures the value of residential real estate in these 20 major city metropolitan areas: Atlanta, Boston, Charlotte, Chicago, Cleveland, Dallas, Denver, Detroit, Las Vegas, Los Angeles, Miami, Minneapolis, New York, Phoenix, Portland, San Diego, San Francisco, Seattle, Tampa, Washington, D.C. So again, Phoenix and Las Vegas were among those bottom in the top 20, and Chicago and New York were among the top leaders in here in the top 20 city composite for Case-Shiller. All right, here's the 10 city composite, up 3% here for the 10 city composite. And here are the 10 cities tracked. Do they even have that here? 10 city composite measures the change in value of residential real estate in 10 metropolitan areas in the U.S. It's included the Case-Shiller Home Price Index, which seeks to measure change. Actually, it doesn't give us the 10 cities there. Interesting. There's the 10 city again in graph form. Taking a look at S&P Case-Shiller U.S. National Home Price Index, again, just released this morning. Home prices are up over 2.5% year over year. They're up 1% from July to August nationally as well. So big jump there for 1 month. And here's the look going all the way back to, this is on the Fred website. We'll chop this chart out and put it into BAMX for BAMX members, going back to 1987. This is when the great financial crisis was happening right here in 2006, 7, 8. They said, no, home prices aren't going to drop because home values have never gone down. If you look from 87, right, even during some of these high interest rates, home prices were going up. They just basically always went up, outside of like this one little 1990 recession where they were really more flat than going down, but maybe a little tick down there in the very early 90s, and really flat throughout most of the 90s, but then just continuous climb up until the great financial crisis. And then, of course, we learned that real estate prices can crash when there's a mortgage crisis, and they crashed more than they ever had in history. And since that point, we've seen home prices do nothing but go up until, of course, peaking out in June, July of last year. And then we saw that drop as interest rates were ratcheted up, and now we've gone up even beyond that peak. So is this going to be is this our drop here? Is this our price correction and now we're going to continue to go up? Or will there be some type of a double dip on home prices? I'll tell you what I think's going to happen. And then we're going to get into Wells Fargo and Goldman Sachs, who believe that the housing recession is back on. Remember, the end of last year, we were in a housing recession. Housing was in a contraction mode. Okay. And that was labeled a housing recession. When we came into this spring market, we came out of the housing recession technically by these analysts. Wells Fargo, Goldman Sachs say housing recession is back on. So similar to last year, I believe similar to last year, you will see one of these valleys that you see here on the right, all the way on the right of this Case-Shiller chart, where home prices drop down in the winter months. And I think it will be longer into the traditional spring season this year. Okay. So remember, Case-Shiller's lagging data shows us August being up, 2.6% year over year, 1% from July to August. That's great. October is going to tell a different story. Okay, we're sitting here at October 31st. You might have a good feel for your local market right now in October. Home prices up or down, sales up or down, is demand up or down? Let me know in the live chat on those three categories: total sales, prices, and demand. Just your feel for the market. If you don't have all the data as we close out the month here today on this Halloween, maybe you're not going to have the data in your local market for 5 or 7 days. What's your feel? What's the market been telling you the last 31 days? Is this going to be up or down? And remember, we won't get Case-Shiller's look at October until the end of the year. We won't get it until the end of December. By that time, we'll already have known that October was a month where values started to recede. Demand was certainly down in the most unaffordable month, as well as transactions, right? And so this is seeing the market as it's happening and not reacting to what's happened 2 months ago. This is great for homeowners that they have a significant cushion right now on their home values for what happened this spring, for what happened in this summer months. But this isn't going to tell the story going forward. My opinion would be that this dip that we saw from last year when interest rates got up to, and here's the marker, September, when interest rates hit up over 7%. Now we've seen them in this October timeframe, which you don't see in this chart of this year, hit up over 8%. You start to see the prices go down. You're going to see another valley similar to what you saw in last winter. And I think it's just going to be longer this winter. I think this is going to be a very hard 6 months in terms of the amount of transactions, the amount of demand across the country. And that's going to be reflective in prices. Doesn't mean that when we get to this point, Halloween of 2023, that we're not going to be talking about, Case-Shiller year over year home price increases like we are right now. No, it doesn't mean that's out of the question. You could see year over year home price increases like we just saw from August to August, according to Case-Shiller, of 2.6%. You could see the same thing next year when we get August numbers from Case-Shiller, which won't be till next Halloween, of course, because they're 2 months late. We could be talking about year over year home price increases. But over the next 5-6 months, we're going to experience a valley here. And it's one of the reasons why Wells Fargo and Goldman Sachs both agree that the housing recession is back on. I think Lance Lambert did a great piece here breaking this down. I'm going to share it with you. Some daily downloads for BAMX members as well that will drop into BAMX. Wells Fargo: rising borrowing costs stand to tip the housing sector back into recession. So he's talking about, referring to that housing recession, of course, last year. Okay, Wells Fargo analysts wrote, after perking up the start of the year, nearly every facet of the housing activity has shown signs of relapse as the Fed has maintained a restrictive policy stance and mortgage rates have breached 7%. Okay, we don't want to hear relapse in housing. We don't want to hear it with anything. In September, existing home sales extended a 3-month streak of declines and dropped to a 3.96 million unit pace, the slowest sales pace since October 2010. Mortgage applications for purchase have retreated in recent weeks. As of October 20th, they've fallen to the lowest level since 95. In September, the Fannie Mae Home Purchase Sentiment Index reported that 84% of consumers were pessimistic about home buying conditions, a new survey high. This is the reality. You can't tell yourself as a real estate professional that things are just going to change because you believe it, because you're optimistic. Okay, that's not going to get you through this market. It's not going to get you through the next 6 months. It's going to take a different level of doing 3x, 6x, 9x the activities to garner the same results. There are going to be sales. We're at a 3.69 million unit pace. Just means we're not at a 6.5 million unit pace anymore. Okay, we're still at a 3.96 million unit pace. People still have to move, but optimism isn't going to move the market back to 6 months, then back to 6 million. The next 6 months are going to reflect that. Single-family construction has not yet turned down, but NAHB Housing Market Index, which reflects homebuyer confidence, has declined since July, suggesting new construction may also soon begin to slow. Okay, I think that'll happen. You know why? Builders are saying, I'm the one propping up this housing market, taking all the risk, and the Fed just keeps making it more expensive for me to take on this risk. It's costing me a lot of money to go out and finance my projects, to go out and finance my developments. Anybody that's trying to get a development off the ground right now, that's not a national home builder, I've spoken to a few. It's not an easy road ahead. It's a long road ahead. It's very hard to get a new development off the project to begin with because project off the ground to begin with because of how much time and money and energy it takes up front. And if you're financing that and you don't know when these restrictive policies from the Fed are going to ease up, it becomes very stressful. Now, we may get some insight tomorrow afternoon on when these Fed policies are going to ease up. Here's a reminder to subscribe to this channel and hit the bell, because on Thursday morning, we're going to break down everything that Jerome Powell has to say about the housing market as they meet today. The FOMC is meeting today. They're meeting tomorrow. And then tomorrow afternoon, Wednesday afternoon, Jerome Powell will have his press conference here at BAM. We will break down the whole thing line by line. We will pull out all of the data from the 45-minute, 1-hour conference of every moment, every timestamp that he mentions housing, and we'll break it all down here on the hot sheet. So make sure you're subscribed and hit the bell for the notifications. Through July, U.S. home prices, of course, is tracked by the Case-Shiller National Home Price Index, are up 5.3% for this year alone. Okay, so we just went through Case-Shiller year over year. Just for the year, 5.3%. But here's what's interesting. Wells Fargo expects U.S. home prices to end the year being up just 1.8% for that to happen. Remember, Case-Shiller has data up until August right now. So Wells Fargo is saying, oh, just wait till September. Just wait until October hits. And here's what we're seeing for November and December. That if we're going to end the year up just year to date on 2023, up 1.8%, and through July, now August is up 1% year over year. We're up over 6% on Case-Shiller. This means that Wells Fargo believes Case-Shiller's data is going to reflect negative home prices from August until December 31st. For that to happen, for us to get to 1.8% to end the year, which would be up 1 point. Hey, coming into this year being up 1.8%, I think every homeowner, I think every real estate professional takes that, given the variables. Now, being up even more than that, it comes as a little bit of a surprise, I think, to many. But for us to go up 5-6% right now to only 1.8% to the end of the year, national home prices would need to fall over the final months of 2023. And so August was up. So we're up to 6.3% right now. So there's a long way to drop here according to what Wells Fargo expects from September until the end of the year in those 4 months. Beyond 2023, Wells Fargo expects U.S. home prices to rise 2.5% in 2024, followed by 4.4% in 2025. So Wells Fargo is saying, yeah, we're gonna do exactly what I just said in this winter. We're going to have a decline in home prices. I believe it'll extend, deeper into the spring than last year, because I don't think we're starting the spring this year at 6% interest rates like we did last year. So I think it goes deeper into the spring, that valley of home prices. But then Wells Fargo says after that, it's off to the races again, baby. It's 2024 up 2.5%, which would be greater than their 1.8% projection for this year, and up 4.4% for 2025. So let's just say, in this scenario of Wells Fargo's projections, if right, U.S. home prices would end 2023 down 2.8% from June of 2022 from the peak. Okay, so we would end this year below last year's peak. We'd also end 2024 down 0.4% from that June 22 peak, but we would end 25 up 4% from the June 2022 peak. I often talk about the next peak when talking to a buyer who's like, I'm going to buy for the next 10 years, but I'm going to be living here for the next 10 years. I'm buying with the goal of being in this home the next 10 years, but I don't want to buy at the wrong time. But, it's basically like an ego thing. I don't want to overpay for the home. Well, you're going to be here the next 10 years. I can almost guarantee you're buying below the next peak, right? How many times on the hot sheet, hit the thumbs up if you've seen this chart before. Okay, the last 10 decades, the 90s up over 30%. The 2010s were up over 40%. The 2000s were up almost 50%. And that's with the great financial crisis smushed between that decade, still ended the decade up for 48%. The 2020s are up 40+% right now. So buying today, and this is Barbara Corcoran's point about like buying now is the best time, because she's looking at this winter, seeing the seasonality of the home price dips. I'm not saying that I agree with Barbara Corcoran for every buyer because of the mortgage rates. Okay. I actually, I have like a half and half feeling about that. I think if you're a cash buyer, this winter could be the best time to buy, because you're going to be in a power position with the limited demand. And it very well could be that valley. If you buy right in that valley, negotiate the right price, could be a great time for you to buy. But this is where, if you're buying on a 10-year run as a homeowner, someone who's going to use the house, maybe young kids are going to be there for 15 years. Yeah, you're buying below tomorrow's peak for sure. And this is what Wells Fargo's projections are reflecting, that if you buy now, okay, you could end, being down below the 2022 peak, but just by the end of 2025, just 2 years from today, you'll be up 4% from the 2022 peak, and you'll be up over 7% from buying today until the end of June until the end of 2025. Here's where Goldman Sachs and Wells Fargo forecast U.S. home prices tracked by Case-Shiller for the end of 23 and the end for the end of 23, 24, and 25. So Wells Fargo and Goldman Sachs both have nearly identical year-end 2025 forecasts. They also have exactly what I'm saying is going to happen here this winter: a seasonal decline, a seasonal pullback on home prices that stretches deeper into the spring than we saw last year. Okay, so both of Goldman Sachs and Wells Fargo on board with that. Okay, here's some other updated housing forecasts from Goldman Sachs and Wells Fargo, which both say, if you're just tuning in here, both say we have now re-entered a housing recession that we were in last year. We got out of it this spring. They say we've both re-entered this housing recession, despite the fact that Case-Shiller has come out and said we're 1% up on July to August home prices. We're up 2.6% year over year, but that's very lagging data. What Goldman Sachs and Wells Fargo are saying is wait until September and October come out. Okay, here's some other just interesting forecasts. Goldman Sachs says the unemployment rate is going to stick at 3.6% like for the foreseeable future. This year, next year, the year after. Wells Fargo believes it'll go up 2024 to 4.2. 10-year treasury, this is what I'm looking at. Goldman Sachs is just saying the 10-year treasury is going to be at 4.3 next year and 4.25 the year after, which means brace for higher 30-year fixed mortgage rates. According to Goldman Sachs, they're at 6.8 next year as an average. They're at 6.5 in 2025. They have no 5 in their future, where Wells Fargo does. 2025, Wells Fargo's at a 5.7% because they have a lower 10-year treasury yield. Real estate fixed investment, negative 11% this year, negative 10% Wells Fargo, only negative 1.7% 2024, only negative 0.10% for Wells Fargo, positive in 2025. Home prices are up 0.6% for Wells Fargo next year. Again, for Goldman Sachs, I'm sorry, Wells Fargo's at 2.5%. 2025, Wells Fargo is at 4.4, and Goldman Sachs is at the 3.8 that we talked about. Total existing home sales. How many units are going to be transacting? This is an interesting one. Goldman Sachs says only 3.8 million in 2024, and then 2025 will eke out 4.2 million. Those are very low numbers. That's an average. In 2024 and 2025, those 2 years combined, total existing home sales for Goldman Sachs, it's an average of just 4 million a year. That's just taking demand for this year, according to Goldman Sachs projections. That's like we're taking demand for this year and just saying that's going to be the same demand for 2024 and 2025. Okay. When you're at 3.8 million and 4.2 million. Wells Fargo, though, says 4.4 million for 2024. That'd be a bump up from this year. And then 4.7 plus million in 2025. If you're rooting for somebody here between the two, Wells Fargo and Goldman Sachs, to be right, be rooting for Wells Fargo. Okay. Root hard for that horse in the race. They're talking about almost, just under 4.5 million sales for 2024, which would be like 500,000 more than this year. They're talking about almost 8 million for 2025, which will be like 800,000 more than this year. They're talking about lower interest rates, a 5 handle in 2025, while Goldman Sachs is still saying 6.5 in 2025. If you're rooting for someone on this table, we're rooting for Wells Fargo to be right. Now, neither of these guys are ever exactly right, but it is interesting to see on home prices where you have seen some consistency here, and the projections are very consistent on a decline here this winter, going into the spring, before going up next year. Okay, we did have. I'm going to bump the 10 fastest housing markets in the U.S. I'm going to bump that to tomorrow. We've got to record the real word. By the way, another reminder to subscribe and hit the bell to this channel. We've got a real word coming out today at 2:00 that is going to be absolute fire as we break down the last week on the Burnett Stitzer trial going on in Kansas City. This is the last week. They are wrapping things up on that class action suit. So make sure you're subscribed here to the channel. Hit the bell. That'll be going up at 2:00 today. We've got a whole bunch to talk about tomorrow, the last day that the Fed weeks. Thank you, Buying Dominican Republic. Really appreciate the nice words there regarding BAM. Before we sign off, let's take a quick look at the 10-year here as we sit here at just about 10 a.m. here on Halloween. We're at 4.863, which is good. It's a little bit down because I was worried this would pop up yesterday off of this news here. The Treasury yield were rising late yesterday and into the early morning, as traders were assessing the government borrowing plan. So if you listen to yesterday's hot sheet, I mentioned, hey, the government still needs to borrow more money. And that's exactly what they're doing. Yields rose earlier yesterday, but they did give up most of those gains. The U.S. Treasury announced it's updating borrowing plans. The Treasury said it will borrow $776 billion in the final 3 months of this year, while strategists at JP Morgan Chase said they expected it to be around $800 billion, so just below. The Fed's set to announce, obviously, the interest rate decision on Wednesday. We're going to cover that here on Thursday morning. 96% chance the Fed will keep rates unchanged. That's down from, it was almost like at 99%. Uncertainty has grown since the Fed meeting in September, when policymakers suggested one further rate hike this year was likely. However, Treasury yields have spiked since then. This is what we talked about, that Wall Street Journal article yesterday. And because the 10-year Treasury, which we're watching closely because it's impacting the 30-year fix so much, is going to be top of discussion as the Fed meets today, starting today and tomorrow, and makes their announcement tomorrow that, hey, these long-term rates could be worse for the amount of money, right, that the Fed, the Treasury rather, has to borrow. It also could be just worse for the economy than what the federal target interest rate is. So they may decide to cool it not only on this hike, but the December hike going into next year. That's what we're all rooting for, because we know that there's going to be a significant impact on this, which is what in housing we track the closest. The 30-year fixed rate, Mortgage News Daily's 30-year fixed daily survey coming in yesterday at 7.92. We'll continue to monitor that, obviously, and hope that will move down just a little bit here today, as the 10-year is down a little bit. That is the hope, and we'll see how it reacts here at the end of the week. That's where we're really watching. So if you're not already, please make sure you're subscribed and hit the notification bell, as we will uncover everything going on with the Fed here throughout the week. We've got a big Real Word going on podcast today at 2:00. Appreciate all of you, and I'll see you guys soon. See you in the comments as well. Until then, toodaloo.